Are you aware that this is one of the most resilient, most sustainable, most innovative cities in the world? London. And what do I mean by all of this? Well, not only is London the greenest city for real estate and #1 global innovation-led city, London remained the top destination for cross-border capital throughout the pandemic so far. Now, I'm a researcher, and I don't naturally lean towards superlatives, but these statements are all evidence-based. Resilient global demand has been broad-based from investors right across the risk spectrum. From those looking for well-understood safe havens to near-neighbour European investors taking advantage of different competition through the pandemic. And this demand for London continues, despite us all existing and operating in an ever more complex and uncertain environment. Markets and investors around the world are trying to figure out the path of inflation and what this means for property prices. Investors are trying to figure out the trajectory of COVID and what this means for future demand for real estate. Investors are also trying to capture structural changes, from demographics to operating in a lower long-term growth environment. Commercial real estate importantly offers favourable risk-adjusted returns amid an environment of equity market volatility, lower yielding bonds and transitory inflation, where transitory could mean more than a year. In addition, London real estate has demonstrated relative stability, potential to deploy large amounts of capital, and the ability to deliver income even through the pandemic. Looking forward, we expect London to gain from record forecast capital flows this year, benefiting from the return of those investors previously challenged by travel restrictions and those who see real estate as an inflation hedge, to those investors taking advantage of London having one of the largest pools of sustainably rated buildings globally. Sustainability is forecast to move up the agenda this year, becoming an increasingly global requirement, driven by investor and occupier demand, the ability to secure finance, as well as regulatory considerations. This all means, as Ollie will set out, that we are likely to see a divergence in performance and pricing between buildings which are green or have green potential and those that don't. London's place as a global centre of green finance is also forecast to support demand for sustainable assets. But even for sustainability, the environment is ever more complex, with embodied life cycle carbon likely to become more important over the year ahead, and already a consideration in the London Energy Transformation Initiative. Now, a number of you have been asking questions to the capital markets teams over the last year. Nick and Ollie are going to answer 3 of these most pressing questions over the next few minutes. These are: how are capital flows changing since the onset of COVID? How is ESG moving to the forefront of investor decisions? And what is the outlook for pricing? Ollie and Nick, over to you. Thank you.
Unprecedented, opportunity, performance. 3 words that encapsulate the next section. Unprecedented global demand, opportunity relating to ESG, driving performance in pricing. 2022 will see the return of capital from all corners of the world as travel restrictions continue to ease. We currently estimate there to be £49.3 billion of capital targeting central London. North American investors, who were the most dominant in 2021, will continue to aggressively push core plus and value add strategies. Domestic and European investors are correcting their underexposure to London, and we expect a number of new entrants to enter the market. APAC investment will be led by Singaporean and South Korean investors initially. However, Hong Kong buyers are likely to remain more subdued in the short term. The role of ESG is adding greater complexity to decision making. At a base level, the minimum energy efficiency standards coming in 2030 provide an immediate challenge for reletting. For the estimated 90 to 95% of London offices rated below B, costs to upgrade buildings could be significant. Other benchmarks are increasingly being used by investors to assess ESG performance. We recently mapped over 70 key London investors and found 90% of respondents are currently using global real estate and sustainability benchmarks across their portfolios. And around 30% are using the carbon risk real estate monitors for their analysis and decision making. With only 15% of trades in 2021 regarded as prime, the opportunity for buyers could come from core plus assets with good underlying fundamentals. However, to find value could involve targeting emerging locations and broadening target requirements. Furthermore, JVs and funding opportunities that aim to develop the yield rather than buying the yield will present an expanding route to entering the market. In the value add space, volumes will steadily increase as owners ill-equipped to meet new regulations start to divest. Smaller lot sizes owned by private capital could be especially prevalent. ESG credentials are now directly feeding into pricing. Finding opportunities to create the right stock will lead to rental and capital value premiums. Knight Frank's Active Capital Research recently looked at how mid-rated BREEAM buildings can achieve 10 to 11% pricing premiums. Our research in Australia for the more familiar Neighbours rated buildings has suggested up to 18% premiums for the very top rated buildings. So, for best in class, the combination of ESG, weight of capital, relative discount to other major cities, and expected rental growth has led to prime yields changing to 3.25% in the West End and 3.75% in the city. Whilst interest rates, inflation and COVID are potential headwinds, yields could potentially compress further over the next 18 months. Return hurdles for ESG-focused assets are also lowering. This reflects the reduced risk premium associated with obsolescence, future reletting and liquidity prospects. Accordingly, target IRRs for some investors can be up to 200 basis points below the market norm. On the other hand, tertiary assets will present ever greater liquidity challenges unless pricing accurately reflects future capital expenditure. The gap in pricing to prime assets is only going to widen. So in summary, ESG is leading to both greater challenges and opportunities. Focusing on the latter will drive performance. And now, I'm going to hand you over to Nick, who's going to talk to you about the residential side.
Both over the long term and through the COVID pandemic, Build to Rent has proven to offer extremely resilient income and long-term appreciation, a rare and valuable commodity in today's world. This has led to a significant increase in investment into the sector. Our comprehensive Build to Rent database of all schemes across the UK give us a unique insight into this rapidly evolving sector. This database is helping our clients to make informed strategic decisions. There has been a lot of Build to Rent activity across London, with 27,000 units now built and operational, 19,000 under construction, and a further 27,000 with planning. However, this really is only scratching the surface. When you consider that all built stock represents only 3% of our rental market, rising to just 5% once all stock under construction has been delivered, it is easy to see the scale of the opportunity. Based on more established markets globally, our analysis suggests that Build to Rent in London will exceed 30% of total stock once mature. This would mean that we are less than 10% of the way to maturity today. The investment opportunity is vast and is now attracting increased capital from across the globe. To date, the market has been dominated by UK, North American and European investors, and this is continuing. More recently, we have also seen a new wave of capital from Asia and the Middle East, a trend we expect to accelerate. The investment landscape is changing rapidly. during 2021, over 60% of UK investments were bought by overseas capital, and crucially, 22% of transactions were bought by new entrants to the market. We, along with our global capital markets network, are here to help you, our clients, navigate these increasingly complex capital flows. One of the key defining topics for Build to Rent over the next 5 years will be ESG. As you heard earlier, ESG is now prominent in many other asset classes. Whilst it has lagged behind for Build to Rent, it is now rapidly moving up the agenda. From our recent residential investment survey, almost 70% of respondents stated that ESG is now driving their strategic decision making. We are encouraging our clients to prioritise ESG in order to future-proof their assets, minimise obsolescence risk, and drive maximum value in the years to come. And legislation is changing. In 2021, the government put forward proposals for all new lettings of residential properties in London to require a minimum EPC rating of C by 2025. Our research shows that 60% of rental properties currently don't meet this threshold and will therefore be non-compliant. This will be a huge issue and significant cost for many private landlords and will lead to a further reduction of private rented properties, driving a shortfall in supply. And this presents Build to Rent with a huge opportunity to replace our older rental stock with more modern, sustainable housing for the future. As with the office sector, repositioning and conversion of older assets will increase over the year ahead. Dolphin Square, which we sold last year to AXA, is an excellent example. The block, which was built in 1935, comprises 1,233 apartments in Pimlico and will shortly be undergoing a comprehensive refurbishment programme. Central to this will be improving sustainability credentials, including replacing all 6,000 windows, substantial thermal insulation works, and moving away from fossil fuels to become 100% electric. So what does all of this mean for Build to Rent pricing? Demand for rental stock will continue to outstrip supply. In the medium term, the impact of minimum EPC changes and population growth are likely to further exacerbate this. This will support strong rental growth in the medium term. Refurbishment and retrofitting of older obsolete buildings will become increasingly commonplace. This will present investors and developers with a huge opportunity to deliver additional stock. And crucially, increasing volumes of core and core plus capital chasing a limited pool of stock will drive in yields. We expect best-in-class stabilised build-to-rent assets to range from 3.25 to 3.5 for secondary locations in London and sub-3 for the very best in prime.
During the course of the pandemic, London proved its gold bullion status yet again with Asian capital, as these traditionally risk-averse investors sought core assets in safe haven markets during times of such uncertainty. Asian capital spent $2.1 billion in London in 2021, representing 23% of all transactions in the UK capital. Considering travel restrictions, this is a significant amount of activity, which was largely driven by Singaporean, Korean and Greater China investors. As the world navigates its way back to normality in 2022, Knight Frank is forecasting this well-trodden route of Asian capital to central London to increase, doubling the 2021 volumes. In general, prime office assets will remain number one on the Asian target list for central London. Even as prime yields in the capital continue to compress, the drive for capital preservation, certainty of income, and high-quality ESG-compliant assets will mean that Asian investors will adjust their return hurdles down to bid competitively in London. That being said, those Asian investors who are already firmly established in the London office market are starting to move further up the risk curve, whether it be taking on some vacancy or refurbishing lower grade assets. Core plus and value add strategies will certainly be evident in 2022. Capital partnering with local managers will be a structure that many Asian investors will increasingly employ to ensure success in this approach.